let's talk about, let's move to a new subject here. And we have talked about liabilities where it's a no, we know who to pay, we know how much to pay, we know when to pay, correct? Haven't we talked about that so far? But now we're going to move into a different area of liabilities. And we're going to talk about when there's uncertainty in liabilities, okay? Maybe there's uncertainty in who you're going to pay. Or maybe you're not quite sure of when you're going to have to pay. And maybe you don't even know how much you're going to have to pay. But you know there's a liability, okay? Some of this, dusting off the cobwebs of your brain, think back to chapter 9. Remember when we were estimating bad debt expense with receivables? It's kind of those same principles. You have all these accounts receivables. You just know there will be people who don't pay, correct? But you don't know who's not going to pay. You don't know how much they are not going to pay. And you don't know when they are not going to pay and go into default, do you? There's a lot of uncertainty there, but you know there's going to be people who don't pay on your receivables. Is that correct? So what did we do in that instance? What did we do in that estimate? We estimated it, right? We didn't know for sure, but we can estimate it using past historic data, correct? Remember when we said, okay, we've been in business for a while, we estimate that 2% of credit sales won't be collected. Or we estimate that 4% of our accounts receivable won't be collected. Remember when we did that? And do you remember which principle we were following in doing that estimation?
Is it
the matching? Very good, Tiba. It's the matching principle. This is a good time to refresh our memory on those principles because I like to ask those on the final. The matching principle states that we want to try to match the expense or book the expense in the same period as the revenue that it's related to. You with me? Not a year and a half later. Even if it's an estimate, we want to try to match that expense to the same period as the revenue. Okay? Let's talk about one of these today. One of these would be warranties. Okay? Let's say you buy an item on warranty. Okay? For example, Jacob, let's say that you sell computer monitors or something. Okay? And you offer a 6-month warranty on this, parts and labor. Okay? Well, you have all of these sales of computer monitors, but do you see how, and you know somebody's going to take you up on those warranties, right? But you're not sure of who, when, or how much. Well, this is when you estimate it. Let's look at an example. And again, this is in the realm of looking at your slides. This is an estimated liability. It's a known obligation. It is a known obligation, but it's of an uncertain amount, so we estimate it. Okay, let's talk about liabilities, warranty liabilities specifically. Let's say that we're a dealer and we sell a car for $32,000 on December 1 of 2017. Now we have a warranty for parts and labor for 12 months or 12,000 miles. Now our experience shows an average warranty cost of 3% of the selling price of each car. That's not much different than the percent of credit sales we don't think we're going to receive. This is just from our past history, correct? So when we sell that car, we have to book this entry right here. Now we also have to, make the journal entries for the sales of the car, obviously, but we also have to book this journal entry. We take the $32,000 times the 3%, that equals $960, and we credit estimated warranty liability, and we debit warranty expense. That books the expense in the same month as the sale that occurred, correct? So that abides by the matching principle, okay? So that is an example of an estimated liability that we accrue. Now what happens when somebody takes us up on our warranty? Well, let's say on February 15 of 2018, somebody came in, needed some warranty work done on their car, It cost $250 in labor, and we had to use $200 of parts from our inventory, okay, to fix that car. Well, the journal entry we would make is, let me get my pointer going. We would decrease auto parts inventory by crediting it for the amount of parts that we had to use, right? We would accrue that $250 of salaries payable for the labor of $250, and we would reduce our estimated warranty liability by $450. Okay? You with me? Now, should we expect that that $450 should be the same as the $960? No. Okay? This is 3% in aggregate, okay? This is just like, there'll be some people who never use their warranties, right? And then there'll be other people who need warranty work done, and it's probably a lot more than the 3% of their sales price, correct? This is just like home insurance, right? You pay a certain amount of home insurance premiums, and if your house catches on fire and burns to the ground, they give you a lot more money than what your insurance premiums that you paid out were, right? But that's not a problem to them because most people's houses don't burn down, and they're not going to collect it all, right? So this 3% is, we do it by each individual sale, but we're not expecting that each person is going to do exactly 3%. Are you following me? Okay.